Vertical spreads can be an excellent strategy for creating growth. Because vertical spreads are a limited risk, limited reward strategy, they're relatively straightforward to manage as well. This video is going to demonstrate a couple of different approaches to entering vertical spreads for growth. The main idea of using vertical spreads to create growth is to profit from price movement. Bullish vertical growth spreads are constructed by selling a higher strike option and buying a lower strike option with the same expiration. A bullish vertical spread can be constructed using either puts or calls. A bullish vertical growth spread is going to be constructed using options with strike prices that are higher than the current stock price. So using calls would be an out of the money trade, and using puts would be an in the money trade. Since out of the money options are usually more liquid than in the money options, most retail traders prefer to use calls to create bullish growth verticals. This trade is called a bull call spread, also known as buying a call spread, and that's the type of trade that we're going to focus on here. The type of stock that this strategy makes sense for is one that is bullish in a bullish market environment. The typical time frame for a growth vertical trade is anywhere from a week to 45 days, although it can be longer. There are pros and cons to shorter versus longer time frames. Shorter time frames have a higher theta, lower probability, and therefore higher potential daily risk. But shorter time frames also have a higher gamma and have a higher potential return on risk per trade. There are many ways to choose which strikes you're going to use in a vertical spread. Let's examine two different approaches to bullish vertical spread construction. The first approach we'll demonstrate is using delta to help you select an option to sell. For example, you could have a rule that says always sell an option with a delta of about 30. Or you could pick any delta to use. The key is to be consistent with the delta you choose. If you're using this approach, you wouldn't say, well, sometimes I use 20 delta and sometimes I use 40. You need to be consistent with your delta. A lower delta would give you a lower individual trade probability with a higher potential return, and a higher delta gives you a higher individual trade probability with a lower potential return on risk per trade. As with any set of rules, there are pros and cons to the delta approach. The pros are that by being consistent with your delta selection, you should theoretically have a consistent win rate, and you don't have to worry about knowing which strike to sell, which makes your analysis easier. The biggest con to this approach is that sticking to a system that only allows a specific delta could be too rigid in certain circumstances. For example, you may want to be more conservative or more aggressive in different situations, but a strict delta rule won't allow for that. Let's look at an example of a growth vertical spread constructed this way. Here we have a stock trading for just over $151. The overall trend is up, the stock is pulled back, and it looks like a potentially good entry for a bullish vertical spread. We can see that the call that has a delta closest to 30 is the 155 strike price. So we're selling the 155 strike call. In this example, we'll buy an at the money option. That's the 150 strike. We're using options that expire in 27 days. Our entry in this trade is a debit of $2.06 per share. That means the most we can lose is $2.06 per share, or $206 per contract. The difference between our strike prices is $5. Well, that means we could profit $2.94 per share, or $294 per contract. That's a 142.7% return on our risk in 27 days if the stock closes above $155 at expiration. This is an example of entering a bullish growth vertical spread using delta to determine our sold strike. Another approach is to use trend, support, and resistance to determine your selling strike. Well, there are also pros and cons to this approach. The biggest pro is that it allows flexibility. If you see an opportunity for a more aggressive entry or a more conservative entry, you could take it either way. It allows you to consider more flexibly market conditions and individual security analysis. The downside is that this approach may allow you to justify entering or not entering a trade and may be less consistent than a set delta. In this example, we're going to use a stock trading for $168. The stock is in a long-term uptrend and has recently pulled back. If the stock continues its trend, there's a high likelihood of it moving above its previous high of $172 and maybe getting as high as $175 within the next 45 days or so. Based on that premise, let's sell the 175 strike call. With both of these techniques, we're going to buy close to at the money or just out of the money. In this case, the 170 strike. This example is a 41-day trade. Our entry in this trade is a debit of $1.81 per share. That means the most we could lose is $1.81 per share or $181 per contract. The difference between our strike prices is $5. That means that we could profit $3.19 per share or $319 per contract. That's a 176% return on our risk in 41 days if the stock closes above $175 at expiration. This is an example of entering a bullish income vertical spread using trend to determine our sold strike. Well, the next question you may ask is, how wide should I go with my strike prices? We can give you some basic guidelines to experiment with on paper while you figure out what style works for you. These basic guidelines are assuming the same sold strike price. Generally, verticals with a larger distance between the strike prices react more quickly to price movement due to having a higher overall delta. The benefit from that is that if your forecast is accurate, you can exit the trade quicker at your profit target than in a narrower spread. Wider verticals also have more exposure to volatility and usually a lower return on risk. Narrower spreads usually offer a higher return on risk, but much lower exposure to price movement, time decay, and volatility. This means that you normally have to hold on to narrow vertical spreads longer before you can realize your target profit. To begin using vertical spreads, come up with a set of entry rules to follow. You can use the examples provided in this video to help you get started in your virtual account. Be consistent with your entry techniques and watch the videos on vertical trade management to study how to exit these trades.